Welcome to The Explainer. We're going to tackle a question today that every single investor has to face, whether you're just starting out or you've been at it for years. And that is, how much risk is actually worth the reward? Let's dive in.
So when it comes to investing, how much risk is too much? This is really the core question, right? It's that constant push and pull. You've got the dream of making some serious gains on one side, but then there's that very real fear of losing your hard-earned money. So where on earth do you draw that line?
And this, right here, pretty much nails that basic trade-off. You've got your low-risk savings account. Think of it like a piggy bank. It's safe, it's secure, but your money isn't going to grow much. Then, on the other side, you've got a high-risk investment. Let's call it a rocket ship. The potential for high returns is huge, but there's also a much bigger chance it might, not exactly stick the landing. That old saying, nothing ventured, nothing gained, it's true, for sure, but it definitely doesn't tell you the whole story.
Okay, so to really navigate this stuff, we've got to get on the same page. Let's lay down some ground rules and get clear on what these two key terms really mean.
First up, risk. What are we actually talking about here? Well, in the world of investing, it's basically the chance that things don't go to plan, and you end up losing money. I love this analogy. It's kind of like slipping on an icy pavement. It's a possibility, it's always there, and you can't just ignore it. You have to actively manage it.
And then there's the return. That's pretty simple. It's what you get back on top of what you originally put in. But here's the thing you absolutely have to remember. Returns aren't always a good thing. Since investments can go down just as easily as they go up, a return can be negative. And a negative return just means you've lost money. Plain and simple.
What's really wild about all this is that your gains or losses, they're not actually real until you sell. Seriously, as long as you're holding on to that investment, its value is going to be all over the place, up and down. Think of it like this. It's just an on-paper gain or loss until the moment you decide to cash out. Like Lenny Kravitz said, it ain't over till it's over.
So what this all boils down to is that this isn't just about spreadsheets and market trends. It's about you. To invest smart, you have to look in the mirror first. You've got to understand yourself. So let's do that. Let's figure out your personal risk profile with a few key questions.
Okay, first question to ask yourself. What is this money actually for? Is it for a really specific long-term goal, like retirement, way down the road? Or is it for something closer, like a down payment on a house in a few years? Or maybe it's just for a rainy day fund. Believe me, your goal completely changes the game.
All right, next up, how soon do you need this money back? This is a big one. The longer your time frame, the more you can afford to just ride out those market waves, the inevitable ups and downs. A good rule of thumb is that if you can invest for at least 5 years, you've got a much better chance of smoothing out all that short-term craziness.
And you've also got to think about this. Will you need to get your hands on this money sooner than you think? Could some unexpected life events, a job loss, a medical bill, force you to sell at the absolute worst time? Or is your cash going to be locked in for a while? Needing money in a pinch can take a theoretical on-paper loss and make it very, very real.
And now for the toughest question of all. Be honest with yourself here. Could you actually afford to lose all of this investment? Nobody wants to think about that, obviously, but you have to. Would losing it all be a small bump in the road, or would it be a complete financial disaster? It's so important to know the answer.
Now, for a bit of a practical guidepost here, the Financial Conduct Authority has a pretty solid rule of thumb. They suggest you should probably limit your high-risk investments to no more than 10% of your net assets. And just to be clear, your net assets are basically everything you own: savings, other investments, property, after you subtract any debts you might have.
Okay, so once you've got a decent handle on your own risk profile, you can start using some really powerful strategies to manage it all. So let's move on and get into the strategy session.
Strategy number 1 is all about striking a balance. It's not about going all in on risky stuff or hiding everything in a savings account. It's about creating a mix that works for you. You want some higher risk investments that are aiming for real growth, but you balance them out with lower risk ones to give you some stability.
And strategy number 2 is, well, it's a classic for a reason: diversification. I know, you've heard it a million times, but it's honestly the foundation of smart investing. It's simple. Don't put all your eggs in one basket.
So what does that actually mean? It means spreading your money out across a whole bunch of different kinds of investments, things that tend to react differently to what's going on in the market. We're talking international stocks, bonds, maybe some property that isn't your main home. Even good old-fashioned savings accounts are part of the mix.
And here's a great visual of how that works. See, in a diversified portfolio like this, if one slice of the pie is having a bad year,
say the shares are down, the other parts, like bonds or property, can help cushion that blow. The whole idea is just to smooth out the ride over the long haul.
All right, so let's wrap this up. We've covered a lot of ground. What are the big things you should walk away with?
It really comes down to these 3 key takeaways. First, you've got to understand your own personal risk profile. Know your goals, your timeline, and what you can stomach losing. Second, take what you've learned about yourself and strike that right balance between risk and potential reward. And third, I'm going to say it one more time, diversify your investments.
So, we'll leave you with this final question to think about. Now that you have a framework for thinking about all this stuff, knowing your profile, what's your next move? What's the next smart, responsible step for you? Thanks for tuning in.
Thanks for watching. If this helped you, please like the video, subscribe to the channel, and tap the bell to get notified when we post new ones.